Let's have a discussion about the Collateral Support Fund and your interest in that. Let's talk about what the opportunity is. Premium finance life insurance is been around for quite some time, greater than the part of 30 years, and it allows affluent individuals to secure large insurance coverage by borrowing the premiums and preserving their assets and their liquidity. And we really talk about 4 arbitrages for clients. Archimedes said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." Now, from a premium finance life insurance industry perspective, here's why clients that can qualify choose to do it. Number one, they can earn more money on their dollars than the cost of borrowing those funds from the bank. They're really good at making money. They've got good IRR in their businesses and their funds and their investments. Why would they divest those to then pay a premium to an insurance company when they can leave those dollars invested, pledge them as collateral, and then get a cheaper loan from the bank? That's been going on for years, and that arbitrage still exists today. Number two, the internal buildup of cash value inside of the life insurance policies historically has, on average, outperformed the cost of borrowing those dollars from the bank. We've got various videos on that. We've got lots of materials to prove that from a historical perspective this takes place. And that's the second reason why clients tend to do it, is the arbitrage that's created in the internal buildup of the cash value of the policies. The third arbitrage is that the premiums that are being borrowed from the bank are tax-free loans. If a client is going to pay the premiums themselves, which is totally fine and a very viable option, they have to earn those dollars, pay tax on those dollars, and then pay the premium to the insurance carrier. Depending on the state that they live in, this borrowing of the premiums to fund the life insurance policy can save the client up to 50% in taxes, because they don't have to earn the money, pay the tax to pay the premium. They're borrowing the money from the bank. And the fourth arbitrage that exists is the gross death benefit of the policy. When properly structured, the gross death benefit of the policy is going to always be in excess of the outstanding loan balance. So there's always going to be a tax-free, and if structured properly in the United States, estate tax-free death benefit that goes to their beneficiaries on record. And again, this is when it's properly applied leverage. And the audience for this across the country, carriers set the guidelines for who can quote unquote qualify for premium finance. It is about $10 million of net worth and up. Some carriers are underneath that $10 million threshold, but the majority are $10 million of net worth and up. And they have to have a pretty decent liquidity ratio of that $10 million of net worth. They have to have a pretty decent liquidity ratio. And so what we're trying to do, what the fund is trying to do, is to provide support of the collateral to mitigate the liquidity risk and sustain long-term insurance funding of these strategies to prevent these policies from imploding on themselves. Premium financing is already a major force in the life insurance market. And with the growing economic volatility, not only in the United States, but across the globe, the need for liquidity inside these structures has never really been greater. There's different statistics out there, but the best guess that we can come up with is that there's about a 20 to 40% penetration of all indexed universal life insurance policies that are in the market involve third-party financing to some degree. The industry itself is $6 billion of first-year premiums a year in the last decade. And that's only going up. LIMRA reports keep showing that IUL is the best-selling life insurance product on the space, and that's compared to whole life, universal life, and variable and term insurance. So what's the problem? The problem is, 1, improper design, 2, greedy clients, greedy life insurance agents, and external problems, macroeconomic problems of rising interest rates and market volatility. From an interest rate perspective, volatile interest rates have exceeded returns on many of the life insurance policies in recent years, which is triggering collateral calls or margin calls, which in turn puts the clients in a liquidity squeeze. They lack the sufficient liquidity or willingness or the desire to pledge or post those additional collaterals on such a short notice. And then the lenders, they don't like being unsecured. They will not be unsecured for an extended period of time. And so then they demand immediate repayment, or what they're going to do is they're going to close the loan out. They're going to de-risk it through forfeiture and surrender of the design. It just creates this domino effect of problems. And if you give me a little bit of leeway, let me kind of show you what that would look like. So I'm not suggesting this is the proper or improper design. I'm just showing what exists out there in the marketplace as an example. So this is a 45-year-old, a $20 million policy. The issue with this particular design is it's going to show the client paying nothing out of pocket for this design. It doesn't mean it's free. It just means the client is not only choosing to finance the premiums, but the client is also choosing to finance all of the interest in the design. And what that causes to happen is it puts a tremendous amount of stress and pressure on the growth of the cash surrender value of the policy, because the cash surrender value of the policy is the asset that the bank is using as position one against the loan that's outstanding for the client. Now, the client is borrowing premiums and the client is also borrowing interest. So in year one, they've borrowed $1.3 million. And in this particular design, for this particular product, the cash surrender value was projected to be $630,000. So the math between 1.3 and 630 is $700,000. And in year two, same thing happens again. It's a wash, rinse, repeat. And here is, a projection of what interest rates would have done. So when this was run, interest rates plus the spread was about 6.7 cost of money, projected to go 5.7 cost of money, 5.2 cost of money, 4.7 cost of money. And then going down from there and then maintaining, when it holds true at 4% of loan expense, it's just really illustrating the difference between the policy crediting rate of 6.4 and 4% of cost of money. So a 2.4% spread on the arbitrage. And this is great, fine and dandy if everything works out this way for the client. But what if it doesn't work out this way? In their mind, the client has locked in, I'm telling you the problems of this type of design. The client is locked in, well, I'm only gonna have to pledge $700,000 this year. Then I increase it by $150,000 to $853,000, increase it to $988. And the client expectation of a peak amount is that it's going to be up to $1.1 million. But that's not always how it works out, because in these designs, they have to be stressed. And this is an example of a stress on the policy when it earns 0% for the first 6 years, as opposed to 6.4% for the first 6 years. Instead of earning interest inside of the asset that's being pledged as collateral, it's earning 0% because it's in that index universal life. And you can see the difference. So this is what the client had in mind of 100% collateral pledge of the assets. They were going to get a peak of $1.1 million. But if things went bad in any direction, if the policy didn't perform or interest rates spiked higher for a period of time, their peak collateral goes from $1.1 million to nearly $2.93 million at a peak. And not only that, where they were expecting to be out of pledging collateral in year 12 or 13, that extends all the way down to year 19 now. And that's because this design, again, I'm telling you the problems, and I'll get back to the deck here in a second. That's because this particular design that this client or this agent would have shown the client $0 out of pocket, and then the client bit off more than they can chew, and they really didn't have the collateral capacity to manage that, right? This is also the opportunity of the fund. But a proper design, and there are proper designs that exist out there, and this is what we would do on new origination of these types of plans. Let me pull that one up. Is when the client decides to, or is advised to, I should say, better use of words, the client is advised to pay at least a portion out of pocket. Now, what we tend to do and how we structure this properly for clients is anywhere between 5, 10 to 15% to 20% of the premium that they're borrowing to have the client pay that out of pocket. And so we've kind of done that here in a different way. The client has borrowed in total, if you look at these premiums for 7 years, they borrowed a total of $10.6 million. And we show the client paying $1,069,000 out of pocket over a 14-year window. So they are paying 10% of the loan amount. And by doing that, it controls the peak collateral of the design, right? The more the client pays out of pocket, the more they pay the loan down, the more control that they're going to have over their collateral capacity, right? Additionally, assuming this client's peak collateral is $1.1 million, from a suitability standpoint, we want to make sure they have $2 million or $2.5 to $3 million of liquidity, so there's capacity in the event we have some zeros that exist in the design, right? Going back to the deck, this is the opportunity, right? Is the opportunity to then restructure the plans and the design of these policies. And this is part of our solution, right? So we want to, number one, stabilize the collateral. The Collateral Support Fund is going to offer a liquidity backstop and reduce reliance on the immediate collateral posting. So provide a liquidity backstop. We're going to support that collateral. Asset preservation. This avoids the liquidation, the surrender that the banks are going to do. The banks don't want to surrender and liquidate these policies. They want the policy to stay in force. They want the loan to stay intact so they can continue to earn interest. The banker that structured the deal doesn't want their compensation cut either. So everybody is motivated to make sure that these structures stay in force. And then also what our solution is going to provide is long-term sustainability, enhancing the policy durability and borrower confidence in premium finance programs, and quite frankly, going to rescue the industry from that perspective. And here's the Collateral Support Fund, the deployment philosophy. Number one, you're going to focus on discounted policy acquisitions. Target acquisition of distressed, under-collateralized life insurance assets at significant discounts. Two, we're going to tailor collateral financing, right? We're going to provide flexible liquidity solutions that preserve client assets and policy integrity. We want everyone to win here. We want the client to maintain a policy. We want the carrier to maintain a policy that's in force. We want the lender to maintain a loan that's in good standing. And we want this to be a win-win-win-win scenario for everyone involved. Because the idea here is these clients, they need these policies. They've proven that to the carriers. They just maybe bit off more than they could chew, or the agent designed it improperly, but we have the ability to come in and structure that and save that. And then strategic optimization. We have, through new originations, that's an opportunity. Through new originations, we can support collateral from the jump on these, or reconfiguring existing policies for better returns, longevity, and future capital leverage. Here's what these four pillars of our design would look like that are non-correlated to one another. One, distressed asset acquisition. Acquire undervalued, underperforming premium finance policies with upside through restructuring. And that's making sure we get the best loan terms, rates available for them so we can help that arbitrage model that I mentioned at the beginning. Policy optimization. So we're going to reconfigure these policies for improved returns and structural efficiency. There's some bad policies out there. There's some companies that have changed the policy. They've moved the goalpost for the clients. And we have the ability, through our distribution channel, we have the ability to search the entire marketplace. We are very well versed in what are the policies that are worth financing and the companies that are worth doing business with long term. And then collateral financing. Provide liquidity solutions that support the continuity while protecting policyholder integrity. These people need the policies. And then lastly, the fourth component of our structure of the fund is litigation finance. We're going to invest in high-value claims with a synergistic legal expertise and potential for outsized returns. It is an incredible opportunity. There's lots of litigation opportunity in this space. What's it come down to? Our management team and our advantages. Number one, expertise, network, and positioning. So we have a multidisciplinary team led by experts in the life insurance space, underwriting, structured of credit, premium finance, and all with proven track records. No one with less than 20 years experience in their particular focus and discipline. The legal expertise, advised by top-tier insurance litigation firms, enhancing asset security and dispute resolution for clients. And then strategic positioning. The Collateral Support Fund is going to be a first mover in a distressed segment with proprietary sourcing and industry access. And as we move forward, The target is 500 million. This could easily get to $1 billion plus, 2 billion with the opportunity that exists. But to start off, 500 million with an expected IRR between 10 and 15%. And the initial anchor investment of 50 to 100 million unlocks the preferred economic terms and strategic influence, right? So being the anchor investor is going to give you preferred status in this deal. And if we have already got the anchor investor by the time you see this video, we're still going to be out here targeting the 10 to 15% IRR for you in a pretty stabilized asset class, again, providing diversification and alpha for your overall portfolio. Exposure to 4 uncorrelated strategies, as I just mentioned. Let me revisit those. Distressed asset acquisition, collateral financing, policy optimization, litigation, finance. And this offers robust diversification and consistent alpha generation. So why now? Why are we bringing this to market now? Why are we funding the fund now? Why now? Rate-driven stress. This is a timing, the disruption that existing in the marketplace is kind of an alignment of all these opportunities. So rising interest rates have destabilized the premium finance space. Some people got in when interest rates were very low. Their cost of money was less than 3%. Within a short window of time, 2.5 to 3 years, that 3% cost of money spiked to 7.5%. Today, we're back down to a little bit below 6%. So those clients that got in at 3%, their modeling didn't show a spike up to 7 and then sitting at 6% right now. They've got collateral stress. 2, institutional shifts. Investors are seeking asset-backed alternatives with downside protection, which is what this provides in alternative markets, volatile markets. And then the first mover advantage. The Collateral Support Fund leverages current market dislocation to build value before the competitors mobilize. And there is a mobilization taking place because there is a huge need for the Collateral Support Fund in the premium finance space. To be first mover in the marketplace is going to give us a tremendous advantage. Here's the team, here's the committee. So with that, contact us. Let's join the anchor round, let's get going, and let's collaborate on a strategy. Hope this has been helpful for you. Reach out to us with any questions that you may have regarding the next steps. Talk to you soon.